3 rate rises in 5 months, CPI to 4.2%. If you own a commercial business or property, you've probably got one eye on the news and one eye on what it means to the value of what you've built. In this month's update, I'm going to show you what's actually happening in the market. No predictions, exactly what's happening in the streets around New South Wales and Australia. 5 real sales, real prices, and real yields, and give you the honest read on what it means if you're planning your exit over the next 3 to 10 years. Let's get into it. Let me set the scene quickly, because context is everything right now. On the 6th of May, the RBA raised the cash rate by 25 basis points to 4.35%. That was an 8-to-1 majority vote, a strong signal. Governor Buller has been clear. The Middle East conflict is pushing fuel and commodity prices higher, and that's feeding directly into inflation. CPI for April came in at 4.2% annually, above the 2 to 3% target, and higher than the 3.7% we were tracking in February. And the June decision? It's live right now. The big 4 banks are split. BA and ANZ are holding no further hikes. NAB has penciled in for August. Westpac is forecasting 2 more, which would take the cash rate to 4.85% by spring. The highly leveraged buyer has stepped back. The buyers I'm seeing who can move with confidence are equity rich. They're either self-funded or borrowing modestly. That narrows the buyer pool, which means positioning and preparation matter more than ever. And here's the thing, quality assets in good locations are transacting. Let me show you exactly what it looks like. I'm presenting 5 sales the last month across retail, commercial, industrial, and development. Each one tells a different story, gives you a breakdown of what's going on in the marketplace. Firstly, a little shop in Haymarket at a 5.2% yield. 53 square metres, ground floor, right in the heart of Chinatown, sold for $1.43 million. Currently leased at about $94,000 gross, which works out to roughly $75,000 net, a 5.2% net yield. There's a short lease remaining, but in this precinct, vacancy is almost never a problem. The foot traffic does the marketing. This is a strong result and tells you something important buyers will accept. Short risk when the location itself is compelling enough. For owners of metro strata retail in high traffic areas, the location premium is real and buyers are still paying for it. The second sale, this is not what it looks like on the surface. Barrack Street in the Sydney CBD, currently operating as a restaurant and bar, sold for $19 million. First instance, must have done really well. They're paying a ridiculous rent. I'm not sure what the rent they're paying. I think it's pretty much a short lease or vacant, almost vacant at the moment. Let's see. Let's look beyond the surface. That price does not reflect the hospitality business. It reflects the land. The site carries an 8-to-1 floor space ratio with a 60-metre height limit. Whoever bought this property is probably holding it, running a hospitality operation. Maybe the next door neighbour bought it. And who knows, that height limit may be increased in the future. The lesson is one I come back to every month. Always know your zoning. The highest and best use of your property may be different from what you're currently doing with it. And that difference could represent the most significant value in your entire transactional plan. Done quite a few with clients, converted motels to backpackers, office buildings accommodation, such as boarding house, industrial buildings to combination of residential and retail, subdivisions. All these things must be looked at because you've got to look at the highest and best use and do your homework Thirdly, we go out in the western suburbs of Sydney in Penrith. A clean 5% yield, good quality tenants, long leases. The result is what buyers are chasing right now. Income certainty, long leases, strong covenants, documented income. The corner location adds future flexibility. For owners of multi-tenanted commercial buildings, this is a benchmark. Long leases with quality tenants don't just generate good income. They're the single most effective thing you can do to maximize your sale price. As you've seen with this example and others in previous months I've covered with you. Let's move on to another smaller property in Cremorne. A retail strata in Cremorne, a hardware store, long lease, reputable national style tenant. Sold for $2.55 million, net rental of $163,000, a 6.4% net yield. Now notice that yield gap. Haymarket came up at 5.2. On the other hand, this property at Cremorne went for 6.4%. Both metro in Sydney, both strata retail, both tenanted, but a 1.2% difference on a 2.5 million assets. That's real money. Why? Cremorne can go through softer periods between tenants. Reletting strata retail on the lower North Shore carries more risk than Chinatown, and buyers have priced that into it. The tenant covenant and the long lease have done a lot of heavy lifting here. Take either of those away and that yield would be materially higher, which means the price would be materially lower. Now we move on to industrial. Fifth, this one's in Alexandria, 463 square metre site, 443 square metre building, short lease, sold for $4.05 billion. Alexandria sits at the intersection of several demand drivers. It's close to the CBD, close to the airport, and sits in the middle of one of Sydney's most active urban renewal corridors, Green Square. The short lease and compact building suggest this sale price reflects considerably more than the current rental income. The land story, the proximity to infrastructure, the alternative use potential is doing significant pricing work here. 5 properties, $34.85 million in total volume, yields between 5 and 6.4 on income producing assets. With 2 properties, Barrack Street and Alexandria, price well beyond the current income on the basis of development land value. So what are the consistent themes? Long leases, strong tenants, documented income, clear locations. These command the tightest yields and the most competitive buyer pools. Short leases, reletting risk or location ambiguity widen the yield, which means lower the price. Location premium is real, but it's not uniform. Haymarket and Cremorne are both good Sydney location, but the 1.2% yield gap between them shows that even within the metro area, buyers are making fine-grained judgments about risk. If you own a rental property anywhere on the metro to regional spectrum, it's worth understanding exactly where your asset sits in buyers' minds, because that gap directly affects what you achieve at sale. And development potential is being priced. 2 of these 5 sales reflect something beyond current income. If your property is near infrastructure, in a growth corridor, or carries zoning controls you haven't looked at since you bought it, it's worth a serious look before you make any decisions for your exit. This month, I've also written about lifestyle and boutique accommodation, a sector I'm seeing more buyer activity at any point in the last decade. Ecotourism projects and properties with genuine natural environments, development approval for expansion, and strong location stories are attracting a specific and well-capitalised buyer pool. I go deeper into those buyers and what they're looking for in the newsletter. Link, which is in the description, the Transition Edge. Every month, I leave you with one action worth taking. This month is this. Check the New South Wales planning portal for your commercial property. It takes 10 minutes and it's free. Look at your zoning, your floor space ratio, your height limit, and then look at your neighbouring sites. And look what neighbouring sites have been approved to build. Most commercial owners haven't looked at these controls since they purchased. Planning policy changes. Rezoning happens. A property that was conservatively zoned 5 years ago may have its envelope expanded materially. And if you don't know that, you may be significantly underestimating the value of what you own. That is not a minor oversight. In 4 decades in this business, I've seen owners leave substantial value on the table because they sold on current income alone, without understanding the development story underneath their asset. 10 minutes, New South Wales planning portal, worth doing this week. That's the June market update. 3 rate rises, a tight buyer pool, 5 sales that show quality assets are still finding buyers at strong prices, if preparation had been done. If you'd like to go deeper into any of this, the June edition of the Transition Edge newsletter covers retail property, yield spreads, development upside and zoning, and the growing buyer pool for lifestyle and boutique accommodation. Link in the description. If you're a business or property owner starting to think seriously about your exit, whether it's 2 years or 10 years away, I'm genuinely happy to have an early conversation. No agenda, no pressure, just a frank discussion of where you are and what your options look like. Contact details are in the description. I'll see you next month.